A new AM Best report looks at the performance of major Asia-Pacific reinsurers that appear on the rating agency's annual Top 50 Reinsurance Group ranking. Here to discuss the findings of that report is Christie Lee, Senior Director, Analytics, AM Best. And Christie, how does the performance of Asia-Pacific reinsurers compare with the rest of the industry?
Thanks for having me, John. The major Asia-Pac reinsurers continue to deliver a stable combined ratio and ROE in 2021 as compared to global peers. This is according to our AM Best Asia-Pacific Reinsurance Composite, which we created from including a group of selected Asia-Pac domicile reinsurers from the top 50 reinsurer list. From the statistics, we see that the composite's 5-year average ROE is 5.8%, having ranged in the last 5 years from 4.9% to 6.6%. While we observe that the loss ratio shows an increasing trend, this is offset by a decreasing expense ratio, resulting in a relatively stable combined ratio that hovers around 100% technical break-even point. Investment returns were stable, and therefore the composite operating ratio has been stable in the past years at around 94%.
Are there any specific traits unique to Asia-Pacific reinsurers that leads to such a stable operating performance?
Yes, there is something quite unique in Asian reinsurers' business profile. Many major reinsurers in the region have benefited from the home market's strong economic growth in the past decades, as they provided capacity to cedents for capital relief purpose, and therefore they have a large book of proportional treaties. It is quite common that these proportional treaties have loss absorbing features such as wide sliding scale and loss participation clause. They secure a stable but thin profit margin in the proportional book. But being said that, on the other side, on the investment side, many major domestic reinsurers in the region maintain investment portfolios that are quite concentrated in the home markets. Because of the lack of geographic diversification, their investment returns are quite highly correlated with the home market's capital market volatility.
So in recent years, Christie, Asia-Pacific reinsurers have had a larger presence in the global top 50 reinsurance ranking. What's driving that?
You're right. The top line growth is not only coming from the home market economic growth, but also from the effort in global expansion and portfolio diversification. Many domestic and national reinsurers typically have a concentration on net cat risk in the home markets, such as earthquake, typhoon, and flood risk in markets like Japan, China, and Taiwan. As a consequence of it, reinsurers are aware that the net cat risk accumulation in the home market was one of the most significant top risks. So the regional players they pursued organic and inorganic growth through overseas expansion and M&A to mitigate its top risk. A few examples such as China Re's acquisition of Chaucer expanded their international footprint to account for over 1/3 of its P&C reinsurance book now. And Peak Re, Tor Re, and Korean Re have converted their European branches to subsidiaries to support the growth strategy in Europe. This diversification brings a lot of benefits. It enhances return stability, lowers the cost of capital, and improves pricing competitiveness. Let's say if one geographic area, such as the home market, performs badly in a year, maybe due to net cat event, the loss could be offset by good performance from another class of business or region.
Now, what does AM Best expect for this segment in the near to midterm?
2022 is shaping up to be another profitable year in terms of underwriting results because of its relatively quiet in cat loss event year to date. Being said that, we're monitoring recent heavy rain loss development from South Korea. And reinsurance pricing momentum in most markets is expected to firmly support premium rate increases for the 2023 renewal seasons. Japan, for example, continued to harden for the fourth year in the 4/1 renewal to pay back losses from typhoon events in 2018 and 19, but at a more moderate pace relative to the past 3 years. Despite of all these positive elements, the reinsurers are still facing numbers of headwinds, which include retro capacity reduction, especially for aggregate coverage, high retro cost after pricing in the high global inflation and strong US dollar, poor equity market performance in 2022 year to date. Specifically in China, the economic slowdown from zero COVID policy could also potentially drag the top line growth.
Christie, how does alternative capital help the Asia Pacific reinsurance industry?
Asia-Pac reinsurers are relatively late bloomers in regards to including ILS as an integral part of their retro strategy. We feel that ILS capacity can support regional reinsurers in capturing rate hardening opportunities, such as Japan's current rate environment. And both Hong Kong and Singapore government want to develop themselves as Asia-Pac ILS domicile and offering grants to subsidize the upfront issuing costs. This raised the economic attractiveness of issuing a cat bond over traditional retrocession method to regional reinsurers. And from investor perspective, this is also attractive. This cat bond covering Asian risks are an attractive alternative for diversifying from the current ILS portfolio that are largely focused on risks in the US and European markets. So we see this is a win-win to both regional reinsurers and investors.
Christie, thank you for taking the time to speak with us today.
My pleasure, John.
That was Christie Lee, Senior Director, Analytics, AM Best. And I'm John Weber for AM Best TV.